two spots. Turn that off. I was having an issue with the YouTube settings. If someone could check to make sure that the YouTube sounds okay. First, I was worried they weren't going to hear me at all. Now I'm worried that they're double hearing me somehow. So if someone could check that, I'll just read the disclosure. I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I forgot to add in my new long. I added my SMCI short. I got into AMD on Friday, kept it over the weekend. What's the name of that symbol I kept? W something? Wi-Fi. Wi-Fi. A little scary one. It's not a very big position. I'm going to keep it relatively tight. Yep. Cool. Thanks. Thanks to everyone who made sure that the YouTube sounded good. All right, let's jump in. Is it a victory for Bulls because we closed on highs? Is it a victory for Bears because we finished down 0.5%? I would argue that closing on highs makes it more of a win for Bulls than it does for Bears. But all the same, SPYs are down 0.5%. Qs are down 0.5%. IWM is down 0.5%. That's interesting. TLT down 0.75%, a little bit off of its low, moderately concerning if it continues to give downside follow through. The dollar's up 0.66%, still, slightly above the 27.50 in the UPTF, but we continue to not see an acceleration above that level. How did Bitcoin do? Bitcoin closed up 3%. Could make the argument that it's moving more as digital gold and less as a risk asset, because Ethereum is down a percentage point, and I think that this is more of the risk-on assets when you're looking at crypto, is the Ethereums and the other coins. And gold was up 2.4% today as well. So gold and Bitcoin, big up days, defensive plays hitting there. Gold starting to trigger a really, really big breakout on the daily chart. The market closed pretty well here. And we're continuing to trade higher after hours, I think, on this Google news. So yeah, we're up another $1.25 after hours as Google is up $7 after hours on the U.S. judge issues sealed decision in Google online search monopoly case. It's not really giving me much information, but whatever it is, it's moving Google higher, and it's continuing with the SPYs and Qs up as well. So again, we closed on highs. After the long weekend, I had to remind myself what our important levels were for the indexes. So I made sure to really write that down this morning for the morning meeting. The first level that we were looking at is 640. The second level that we're looking at is the space between 638.40 and 637.25. So 640 is a really important level. That's the level that we broke out from back here on August 12th. That was at that time new all-time highs. Prior to that, this July 31st 640 high was creating some resistance that was really important, because it was like a day to take notice of negative Maribozu engulfing candle that took place at the very end of July. So 640 is important. And we gapped down this morning really solidly below 640. When we were doing the morning meeting today, it didn't even look like 640 was going to be in play. We were really looking at our next support zone. Our next support zone, again, being 638 spot 40 to 637 spot quarter. Where am I coming up with those numbers? Well, 638 spot 40 is the low from Jackson Hole 10 a.m., right? When the speech got released and we ripped higher, that low is 648.40. So it's significant. And the low of that day, which is also a real breakout day here for the market, is 637.25. So that like 637.25 to 638.5, let's just call it, was a pretty important next level. We actually spent a decent amount of time today below that. And below that, this market was starting to look a bit damaged. But naturally, we rolled up in the afternoon. We closed on highs. We're continuing to get bought back up after hours. So not only did we recapture 638 spot 40, but we even recaptured into the close 640. And again, now we're at 642. So it seems like, as I'm watching this market continue to move higher as I talk, it seems like the bull market is back on, and we are down on the day, but this does not seem like a win for bears at all. This seems like same old, with the bull strength. I do want to spend a minute catching up on just the market dynamic situation, because I think that was pretty important for today's trading session. So we had a really good update from Goldman Sachs yesterday, really, excuse me, that gave us an update on the flow of funds. The flow of funds here in September get interesting because September is seasonally the weakest month of the year. Particularly the last 2 weeks of September are the weakest 2 weeks of the year on average, going back the last 100 years or whatever it is. So we are at a point here after a massive rally in this market, all the way from those crazy April lows to where we got these all-time highs pretty much at the end of August, where we're now on our first day of September, and there is the potential for things to change. So there's a bunch of different cohorts when we're thinking about flow of funds that we need to be considering. We need to be considering some degree of market structure, like market makers and gamma. We need to be considering like the long short hedge fund universe. We need to be considering obviously the systematic universe, vol controls, CTA trend following, risk parity, retail, and the corporate buyback. Those, I believe, are kind of the main flows that we look at, the most important market moving flows. Well, where do we start? Let's start with the systematics, because we spend so much time talking about them. The systematics are still very neutral here. They don't have a lot to buy. Even if you get a flat to an up tape, you can get like very, very, very small buying over the course of the next month. But the risk from the systematic community now is to the downside. But that risk to the downside only triggers if it actually triggers, right? You need to know where and how the systematic funds can trigger selling. And right now, the CTAs need to get probably to the number we were looking at. We haven't seen an update for at least a few trading sessions, but we're looking at like 6,300 as the SPX level for where the systematic sellers actually can step into the market and begin to sell. So that's the trend following community. The other community is the vol control universe. And the vol control universe, as most of us know, who've been part of the team for a while now, operate based on a 1 month and a 3 month look back. So when we had all of that increase in realized volatility back in March and April, it caused them to be massive sellers. And as realized vol has just gotten tighter and tighter and tighter, it has led to them buying up a massive amount of stock. So we saw this morning that vol control is basically at like the 98th percentile of long exposure. I'm not sure what look back. And CTA CTA trend following community is similar. Like I said before, they have like nothing left to buy. Interestingly enough, though, today specifically, on a flat day, would have been a decent buy day from vol control. They don't got many of those left, but we were rolling off like a 1.5%, I think, positive session from a month ago on the 1 month look back today. So you actually, in a flat tape, would have had a decently large amount of buying coming from vol control. But the numbers that we saw were, if the market were trading down by like more than really like 1.5%, at a percent it becomes unchanged. More than like 1.5%, they actually become sellers. If we could have gone down 2% today, and that's not that crazy. We were down, I don't know what, 1.4% at a certain point today, something like that. If we could have gotten to down 2% today, vol control would have been like a $25 billion seller. It would have flipped that hard. Keep that in the back of your brain as I now discuss the dynamic positioning in the SPX the market makers. So per the Goldman note, the gamma level in the market right now is positive $10 billion. So again, just to remind what that means without going into a whole lesson on how it's derived, that means that if the market's down 1%, it runs into forced buying of $10 billion in the SPX from market makers who need to rehedge themselves based on the down move, based on the positions that they already have. So it was interesting because when we opened up this morning, and I'll get into the other cohorts in a second. When we opened up this morning, we opened up down like what, 1.2%, something like that. So it was interesting because it was enough, we were down enough to remove the vol control bid from the market at that level. Not enough necessarily to bring in vol control selling. You needed to really get us, I think, past like 1.5%. And if you get to 2%, it would have been much bigger. But you also are running into $10 billion of forced buying. So one of the things that I was asking myself when I was doing the morning meeting is I was like, if we could get down 2%, I know that there's going to be $20+ billion of selling coming from vol control. That flow could potentially outweigh the buying that's coming from the positive gamma environment. So when we're gapping down this morning, that was the big question. It was, can we get the downside follow through that triggers some degree of systematic selling from vol control that could outweigh that positive gamma? Or do they hold this gap down this morning? The positive gamma is coming into the market, so it's immediately being bought up, and we trade higher. That was really the kind of the first immediate question. And then what we always want to do when we have these large gaps is study our small time frame. I'm a big fan of fading large gaps, at least initially for quick day trades when they're big. So that was what we discussed in the morning meeting today was, hey guys, we're gapping down so big this morning. The Qs are approaching extreme downside extension. This buy structure is still pretty far away. But the first plan, I think, of the day here is to look for those cute longs off of some sort of an opening low, some sort of a pivot low, just for the snapback to satisfy small time frame extension, right? So small time frame extension. I think everyone who's traded with me for a while understands that the space between the 8 and 21 EMA is the space that I consider to be technical equilibrium for any time frame that I'm looking at. So this morning, you actually had a quick sell on that first bar, but then we immediately start to get bought back up. So you could be long in this case off the first bar for the snapback to the 8 EMA. And it overshot that a little bit, but that's all that I'm looking for on that long. Then the follow-up question was, all right, now that we are no longer extended on the small time frame, can we actually sell back down? Can we break the opening low? Can we get to the point where we're down enough where vol control actually becomes a seller that could outweigh the positive gamma in the market? Those are really the big questions. And we called out a short here off the 10 a.m. high for the SPYs and the Qs. It worked okay. Didn't give immediate satisfaction, but the stop held and then eventually rolled down pretty hard. And then the SPYs did make those new lows, but they still didn't give us any actual follow through. There's still a lot of structural support in this market. And then, of course, again, we closed on highs. Now, the other major cohorts to keep in mind are, one, the long short funds. And the positioning of the long short funds is one of the things that I would point to in this market as being the least bearish layer of probability that's out there. And it's because, I think I discussed this last week, if anyone remembers, back in February, right before we sold off, we made all-time highs, we knew that the long short funds were long at their 97th percentile. Now, back here in, where are we, the beginning of September, when we have the potential of the seasonal weakness, the long short funds are not long at all. And in fact, they've got a lot of shorts on, and there's all these different charts that you can look at. Let me pull up just one quick one that was in Pat's morning note this morning. Where is it? This one right here, showing you discretionary versus systematic strategies. And I'm not sure in this case if discretionary specifically is only institutional. I think it is, meaning not retail. I think it is. But you can see here based on this chart from Deutsche Bank, that the systematic funds are 90% in, but discretionary is only 41%. And the Goldman note says that the systematics are like at the 98th percentile of long exposure. They got nothing left to buy. But that same Goldman note, and also, you can even just see it here in this chart, shows that the long short funds are they're not super long like they were back in February. They're not extremely long at all, and in fact, they have a lot of shorts on. So what that means to me when I'm trying to strategize slightly bigger picture for this market, and I'm thinking about all these different cohorts. We know retail, they're just always buying, right? So I'm just assuming that they're still buying because they always buy. Maybe they buy a little bit less in September, I think, historically. But I'm trying in my brain to wrap my head around, like, all right, September is here, seasonal weakness is here. Are we really set up for this market to be able to have a big pullback, for this market to be able to crash? And when you think about the supportive nature of that positive gamma, the answer is no. When you think about the hedge fund exposure that I just described, the answer is no. Both of those things will insulate the down move of this market. You still also have corporate buybacks, but they're much less in September than in August. You still also have the retail bid, which tends to be historically less in September than in August. But all that stuff is still, it's not bearish. It's not selling, it's still buying. It's just less buying. All of that is really supportive. What you don't have now is the systematic bid, which was such a huge part in driving us up in the May, June, July period. You don't have the systematic bid anymore. And as I was saying, the systematic bid can trigger into selling, but it has to actually trigger. And that was the question for today. And it's funny because it just so happened to be that today we were rolling off that 1.5% day on the 1% look back that impacts vol control. Because a lot of earlier last week, if we were down a percentage point, it would have been met with actually a lot of selling from vol control. But for today's session, it happened to not be that way. It would have been really interesting if this just happened to be the vol control setup from a week ago occurring today, and we were immediately running into $10 billion worth of selling at the open from vol control that's being met by the $10 billion worth of buying from the gamma crew to completely offset each other, to then see how the market trades. So the bottom line is, when I'm thinking about all of this positioning, my biggest expectation for, honestly, the beginning of September is like chop to grind lower, not necessarily a big crash lower or anything like that. The market saved itself once again today. So that's barring a real trigger. We do have some events. So you can always have an event trigger, right? We do have some events, but events can work in either direction, right? They're always, to some degree, an unknown. But we got like another big jobs report on Friday. Maybe that jobs report becomes the trigger that actually gets us down enough to be able to trigger the systematic selling, which outweighs the other stuff that I'm talking about. Or maybe, like I said, it doesn't. Things are in line, they don't move, or even they're positive and the market moves higher. You can't predict those things. But when you get to mid-September, keeping in mind what I said earlier, the second half of September is the last 2 weeks of September is seasonally the worst 2 weeks of the calendar year. Well, by coincidence, or probably not by coincidence, that's really when a lot more of these dynamics could present themselves to the short side, because you'll lose the gamma, right? You'll lose that positive gamma bid when OPEX rolls around, which then sets you up for that second half of September to not have that degree of structural support that I'm kind of discussing. So we'll see when we get closer to that point. There's a bunch of time between now, obviously, in September OPEX, but my general thought process, which I update on a day-to-day basis based on the new evidence as it presents itself, is for September to be pretty well bid into down moves, kind of like what we saw today, just because of that positive gamma and because the long short funds have shorts that they can cover into the down moves. and then maybe that could give way towards further weakness when we get into the second half of September. So it's just like my general big picture thought process on things. Um, I'm not surprised, though I am slightly disappointed that we got bought up as well as we did today. And you're closing at highs, you're recapturing the 640 level for the spies. You still can't look at this market for the S&P and say it's bearish. You might be able to say it's not as bullish as it was, but it's almost hard to even do that. It's hard to look at this chart of the S&P and say it's anything but bullish. You definitely can't look at this chart of the IWM and say it's anything but bullish. And the Qs are still where some of that relative weakness is. But even with the Qs here, they're neutral. They're sideways. They're in between that important like 559 support level and that bigger like 576.50, 577 that I had been looking at. So we are kind of back into the same area that we have been for the second half of August as far as this market is concerned. Even though the Bears had a chance today, they really had a chance and they failed to capitalize on that. So it's pretty much all that I've got. I spent most of today, just kind of managing my swings. We had a few good call outs. I also, I mentioned it really briefly. I started a position in this Wi-Fi, whatever this thing is. Got, I guess the quiet period for the analysts ended. So there was a bunch of sell side analysts that put price targets that seemed to be anywhere from $28 to $40, depending on which one you're looking at. It's a low floater. And I actually thought that the chart looked good. So if it starts to get above 1750, really 1850 to 19, I think is the momentum upside trigger in this thing. But I got a jump start on it versus 17. You just got to be careful. That thing was so thin at a certain point this morning when it first opened up. I got out of my AMD short, which was a really good call out from Friday. I got out of that into like 160 pre-market. I probably could have made a little bit more, but it was gapping down to my target, so I got out of it. And I just got filled on the offer in Alibaba here after the close to liquidate my position. I've had a 140 target in Alibaba for quite some time. I think people know that, so I just got filled on the offer here after hours. So I'm now out of Alibaba, and I thought there was one other that I was going to mention. Can't remember what it is. So whatever. And you're definitely still seeing, like I think it was Brant saying was into the close. Even today, you're still seeing that like GameStop bid, the KSS bid, the stuff that honestly a lot of funds are short, getting squeezed a little bit, and you're still very clearly seeing that retail Johnny is totally buying those call options in the crazy stocks still. So he's doing just fine, and you still are seeing to some degree the froth of this bull market when you're seeing those crazy meme stocks able to trade the way that they've been. Who needs to own Nvidia when you could own a great company like Kohl's that goes up 7%? So that's all that I got. Happy to answer any questions from TG. How do you determine systematics? Where do you get that info? It's all from models that are coming from various banks, and it's interesting because it seems like more and more banks are providing their own models to provide this information. But my favorite two to look at are Goldman and Nomura. I sometimes get some extra research on my desk that I read and I just kind of verbally share with everybody. But otherwise, Pat does a pretty good job getting a lot of this stuff into his morning note. So just a great opportunity for my daily reminder to always read Pat's morning note. And if you read it today, you will see he had some information from Goldman Sachs flow of funds note that I was mentioning earlier, just some of it, specifically on the CTAs. So our Goldman Sachs model estimates that CTAs bought 12.5 billion worth of U.S. equities in August, down 15.1 from July when they bought 27 billion. From July, they were basically buying $1 billion a day. But now over the course of September, in a flat market, they're going to buy $3 billion. They have nothing left to buy. Basically, is kind of where we're at. And then you can see here, as per Goldman's model, a flat tape and an up tape and a down tape over the course of next week, over the course of next month. And you can clearly see here, especially when you look at the 1 month number, the risk from the CTAs is to the downside. flat tape, they might buy $3 billion over the course of the next month, but in a down tape, they will sell 73.7 billion. A lot of the times, this note from Goldman is also coupled with what they call a CTA trigger level, where they have a short term, a medium term, and a long term CTA trigger level that just shows you when the price, based on how they model it, when the CTAs would begin to sell. And it wasn't in here on this one, so I don't have it. I don't have an update. We saw tape posted in the pre-market a note from Bank of America. I don't trust Bank of America with this stuff, honestly, as much as I trust Goldman and Nomura. But Bank of America has the CTA sell trigger like just above SPX 6300. So that's probably where the first one is. I was trying to guesstimate on my own in the pre-market because we didn't have the update, and I was guesstimating that it was stuck somewhere between 6300 and 6350. It's a very wide range. So it's probably closer to 6,300 if you want to go based on what the Bank of America note says. And if I ever get an update, I'll obviously share it with everybody on the team. That's from the CTA trend following community. And then the other one is the vol control, which is a different type of systematic. So they bought $100 billion, I guess, worth of U.S. equities since April 15th. Look at the dramatic snapback in this chart to get them now also pretty back fully in the pool. And it's the same thing. It's like I'm always saying, just because they're massively long doesn't mean it's not bearish in and of itself, right? It's not bearish in and of itself. It means, one, that they're not buying, so it is less bullish than when we were seeing week on week, going back to the numbers that I was just talking about with these CTAs, just huge expected inflows based on the models. It doesn't necessarily mean that they're sellers. You still need to actually trigger the selling. And then Bill Kay, I don't know if he's listening, he gets some great data from one of his other resources that actually is able to break down the expected vol control buying based on the realized movement of the day for that day. And you can scroll up in the VTF and see it yourself. He provided it, I think, at 8:45 a.m. this morning. So it's a lot of what I was just talking about when I was kind of recapping how today's day went versus our expectations in the morning meeting. It was, well, the vol control was actually rolling off this 1.5% look back. So you actually had a lot of vol control support for today, even though they're fairly in the pool, as long as we didn't trade down or up by more than like 1.5% to 2%. So highly encourage everyone every day to read Pat's note. It's big picture and gets pretty in the weeds, but there is some phenomenally advantageous stuff in there. And for me, learning that stuff has just dramatically added to my overall edge in trading. What else? Google must share information with competitors to remedy online search monopoly. Google will not have to sell off Chrome. How are these things moving? Google's mooning. And Apple's also a massive. All right, so it was fun how we had another day and a half bear market. Bull market is back. Yeah, Apple crushing. What else? From Liam, is the Google news just that there is a decision, or is the case dismissed favorable? It seems like it's favorable. This had been an overhang for Google and Apple for like a month. I thought the risk was more to the downside on this. I didn't think that they were pricing this in by this much, but I guess they were. So Google and Apple to save the day. The judge to save the day. Apex joined the YouTube is asking me about gold. Is gold a little extended? Yes, gold is a little extended. I think this is a structural move in GLD, and this is after like a 4-month consolidation, a 4-month wedge. I would not be in a rush to jump in on this to the short side. If it extends a little bit further, maybe you could look for a cute short. I'm long. I hope other people are along with me. I was pounding the table on this one last week that the pattern seemed ready to break to me. My target, to answer your second question, for my swing is 350. So it's pretty wide target. I'm not expecting it to get there in a straight line. I'm expecting some backing and filling, but it's my target, 350. From Liam, seems like a gap worth chasing tomorrow. Would you still look to fade Apple and Google? I need to reassess that in the morning. Those are the types of thought processes that I always typically do in the morning. I want to see where this settles in the morning. But I've already been saying that Apple and Google are my least favorite shorts in the Mag 7 and probably my favorite longs in the Mag 7. I don't personally like the idea of really putting on a lot of new big picture longs in this market as we're getting into the September seasonally weak period, even if I'm expecting the first half of September to be chop. And by the way, what does chop mean? Chop means dispersion. What does dispersion mean? Dispersion means that there will be some stocks that are big winners in order for there to be some stocks that are losers. So it's more of a stock picker's market. But for me personally, for anything that's really bigger picture, I'm just a little gun shy on it right now. I'd rather wait to get through September into October, or maybe even the very beginning of November, before I start putting on a lot more big picture longs. But I've been saying it every day. If I was going to buy any of them, they'd be Google. They'd be Apple. Those are my favorite looking daily charts. But now they're going to be too extended tomorrow. Is the blip buyer UVixie bull? I think if anyone wants to go with an uncorrelated play to the market, the CL futures look pretty bullish. For what it's worth, I've been long via short 60 puts for a while now. Thank you, UVixie Bull, for the trade idea, aka Book Buyer, aka Dave. All right. Anybody else have anything for this Tuesday as we all try to get our heads back on after the long weekend? Going once, going twice. All right. Well, have a great night, everybody. See you all tomorrow.